Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to rip through Twitter or X or whatever they call it these days. We're going to see what people think, what they're posting, what their viewpoints are of the markets, maybe some technical analysis, some wealth building tips, some emotional control. We're going to go over a lot of stuff that's hopefully going to talk about making you a better investor. What are the steps to become a better investor? I'm going to give a lot of my financial opinions here. I've got 18 years in the market. I've been investing, struggled like heck in the beginning, just like everyone else. Then I'd say after I was doing trading, swing trading, shorter term stuff. I've done some longer term stuff. Witnessed some, the end of the last commodity bull market. Tied together the real estate market, created a thesis, created a strategy, controlled my emotions, all that stuff. I'm going to talk about it a lot in this clip here. A lot of it is how to become a better investor. It's not all of that, but it's going to be a lot of it. So definitely stick all the way to the back. I'm going to talk about how to become a better investor in this clip. So let's dive in. Let's see what's going on. Again, if you want to follow me, it's at finding_finance, and you can join the website. You can use me as a mentor. I know some people are asking me and using me as a mentor in all these different question and answer sessions, asking a whole bunch of stuff about investments, about individual companies. Why am I choosing these companies? How am I setting up my portfolio? What am I allocating? And the reasons behind it. And you can allocate whatever you want to whatever companies that you like. But I think everyone needs to understand the risks that they're taking when doing certain things. That is what's going to separate a rookie investor versus someone who's been in the markets for a while, is understanding how much risk you're taking on for the rewards that you're potentially getting. So coming on down, we've got Decade Investor. He says, when I had $30,000 portfolio, 10% return, $3,000. With a $300,000 portfolio, 10% return, $30,000. When I have a $3 million portfolio, a 10% return is $300,000. Get your money invested and let compounding go to work. Now, there's a couple of things here. In the beginning, when you've got a portfolio that is smaller, in my opinion, what you want to focus on is how do you increase your income? How do you increase your income versus your expenses? And getting that money in the beginning is tough. I agree. So focus on whatever you can focus on that you have full control over. You have control over getting a second job, asking for more money at your current job, or getting a different job that makes more money. And maybe you get side hustles or side gigs, being an umpire, being a referee, doing something that is on the side for people that will pay you outright in cash, whatever it is. Get that money, put it in there, and then you need to put in the work. Some people choose the S&P 500 route. They put in the S&P 500. They're going to ride the ups and downs. I don't care where it is. I'm just going to throw it in the S&P 500. Other people want to increase the percent returns, which is difficult. And they want to learn the market inside and out. They're going to have to be playing cycles at that point to some extent. That is what I am doing. Find someone who knows what they're doing, use them as a mentor, and figure out how to play the cycle. It took me a long time to figure that out. You need to expedite that learning process. Knowledge is power. Knowledge is going to be money or returns in this case. And that's not just knowing the cycle. There's other things that you need to understand above and beyond just the cycle. Portfolio allocation, risk reward, cash flow companies versus speculative companies. The retail sector wants to go straight to speculative, get in a very volatile stock, and then emotionally can't handle it. It's not going to do you well if you lose 50, 60, 70% and sold out. Eric Nuttall, I don't think the market really gets it yet. The US SPR release of 2022 intended to offset lost Russian production that never occurred. was wildly successful at crushing bullishness and perverting the market's ability to assess fundamentals. Inventories are rising, therefore demand must be weak, right? I believe that by year end 23, owing to the Saudi OPEC Plus cut, that negative impact on inventory sentiment will be no more. What took the US government a year to achieve will likely be undone in less than 6 months. What then? What then is going to happen? I think we're going to see some pretty big inventory draws. Something on the lines of 15 million barrels, I think, is what the next inventory draw that people were talking about could happen. Now, when the market starts seeing these draws, they're going to be drawing down inventory, and that's going to impact the price. They use the SPR, in my opinion, to slow down the rate of inflation. They're trying to manipulate the market. We'll see how successful they are at doing that. Again, I should say. This guy, he said, thoughts. This is to me. He said, the next real estate crash will be caused by those with 2% mortgages. Here's why. If no homes on the market and there's a demand for homes, since those 2% mortgages don't want to sell, this will be filled. They will be filled by none other than home builders. They will get new permits and will continue to build and build until supply and demand evens out. Look at their stock prices, very high and only going higher. Once mortgage rates drops to 4 or 5%, more sellers will come out, but by this time there will be an oversupply in the market and sellers will be forced to cut to sell their homes. I don't think that will necessarily be the case if the 4 or 5% happens immediately. We could see that interest rates go up more and more and more. It prices out a lot of people. The affordability is bad. And maybe the home builders make an absolute killing, just like he stated. And I think that is true. Now, it could be that once we get through this entire demographic, that mortgage rates will remain above 4 or 5% the entire time. We overbuild, and then the market crashes. But I don't think the crash will be as big, and I don't think interest rates will go down as far. If mortgage rates were to go down immediately, like quantitative easing style, I think the demand will blow the doors off of what is in supply. There are a lot of people on the sidelines who can't afford homes, that want to afford homes, and that interest rate would allow them to afford it. There are a lot. So I know there's a lot of people personally that want to buy homes. They're kind of in flux. They're like, interest rates are high. I'm going to wait for interest rates to come back down. What I would do is, if I could afford it easily, I would buy a house at a higher interest rate where I have the most options. Buy it if I could easily afford it, only if I could easily afford it, and then refinance later if mortgage rates were to go down. That's what I would do. Again, that's not supposed to be used as advice, but that's only if I could easily afford it. If I couldn't easily afford it, I wouldn't lock in a payment that I couldn't afford. Coming down, it says copper broke out yesterday and yields slammed everything back down. Retest on the breakout, perhaps. So we broke out. Now we're doing a little retest. But we get a run here. I'm interested to see over the next few days or weeks how copper behaves and what yields do. Another thing is home builders still showing strength in the face of increasing yields. Are we going to turn here or continue higher? I think there's the case that we could continue higher in home builders. They look very strong. They're having strong earnings. We'll see if that can continue as well. And then uranium. It says URA is still looking solid as ever. We are about to run. URNM breaking out as well. Spot fund about to break out. Are you positioned? We've got a breakout in URA. This is about to run, in my opinion, at any second. It already is kind of running. We have a new, fresh breakout of URNM. We've broken out of this trend line. We have a bullish engulfing candlestick here. We hit our head on resistance and didn't really pull back much. We have another bullish engulfing right here. Guys, this is ready to rip. This is where you better have your portfolio positioned, figured out. You've got the right allocations. and that that you're patient enough to hold for this big rip. Some of these companies might do some crazy stuff over the bull market. Maybe some of them do hit 10, 20, 30 baggers. If that is the case, you have to be willing to ride through some volatility at some point. It's not going to be easy. You better have conviction. You better know what the heck you're doing. And right now is probably the best time to find someone who can mentor you through this. I'm not saying it has to be me or the website or the people who are in the community of finding value, but you should probably find someone who's got some years in the market to guide you and how to be patient, how to control your emotions, and ride through these things. We also have SPUT physical uranium coming up. It's got a pretty good run at this, and we could be breaking that 1815 resistance level. We could run big across the board here in uranium. And it's important that everyone has their head on straight. I truly hope and believe that everyone listening to, my YouTube channel that's been following, I sincerely hope that you guys get the returns that you want out of this bull market. I am here to help you make that happen. Whether you're a part of the website or not, I sincerely hope that you guys do very well. Interest rates, the 10-year look like they are going to run higher. So this is a big picture view. I said in 2020, 2021, when I created the channel, I said we're going to see large inflation. We're going to see the pressure on interest rates to go higher. I said that in my Palisades clip. I said it was going to be driven by the real estate market in expansionary phase and the stimulus money, both of those things. We've got that big move. We've broken the 40-year downtrend. We zoom in on it. We've broken out of this flag pattern to the upside. We could see yields continue higher here. What does that mean? It means that people are selling bonds because that's why yields are going up. And we could also see that rotation of money from bonds and maybe even stocks eventually start to rotate in commodities. We are starting, in my opinion, the third leg or the third wave of the big bull market in commodities. That's why we're seeing commodities outperform the S&P 500. We're starting to see that break to the upside of the falling wedge of that ratio. It's all falling into place. That's why we're seeing uranium break, copper break, precious metals break their big patterns. Are just sitting on top of their patterns on top of support. Everything to me looks like it's falling in place, and we're going to have a lot more information to show you even more so what that looks like. So here's NASDAQ versus Treasuries from Tavi. He says, I keep looking at this chart and asking myself, who is lying? The answer is becoming increasingly evident. Treasuries are breaking a key support today and are likely headed much lower. So this is AKA, this is your yields going up, Treasury prices going down. It is worth noting that the recent government announcement about issuing an additional $1.85 trillion worth of U.S. debt by the end of the year. This is setting the stage for further pressure on 10-year yields to rise, and NASDAQ is yet to be impacted, particularly mega cap tech companies. What we see here in this chart is the red is the 10-year Treasury going down. We hit our support level and we are breaking that to the downside. The NASDAQ generally moves opposite of yields. It moves the same way as bond prices, just like we can see in this section here. It's possible that the NASDAQ is going to come falling back down with those increasing yields. And that money is going to rotate from bonds and the NASDAQ into our stuff called commodities and precious metals. That is the hope, and that is what I think will happen. Coming on down, there's a third and most likely scenario in which the dollar implodes and big tech implodes at the same time. That's what happened in March of 2020, and the setup now is identical. And I don't agree that the setup is identical. March 2020 was a COVID shutdown, and we don't have a shutdown, in my opinion, coming. Sure, there could be a shutdown that I don't know about, but I just don't find it likely. But there is the possibility that the dollar does implode. How does that work? Well, the bond market's going to go down in price, and yields are going to go higher. if they want to stop the yields from going higher and an implosion of the bond market, what countries do is they do quantitative easing. And what that does is it saves the bond market but sacrifices the dollar. And that is where, if they save the bond market and they sacrifice the dollar, commodities and precious metals explode. And I think that might come at some point. I don't know with any sort of certainty, and I don't know when, but that is a possibility. Here's 6 rules from Warren Buffett for managing risks, and I want to get into this pretty good here. This is about investing, emotions and stuff like that, how to become a better investor. Investing becomes a lot easier if you can control your emotions. The question you have to ask is, how do you control your emotions? And the way that I've done it is I created the 3 pillars for investing. It's a strategy. It's an investment strategy to control my emotions and to make it more of a process and a strategy/process than me running around with my emotions. The 3 pillars are ratios, market conditions, and technical analysis. Why do I have that? Well, ratios tell you where the money is and isn't. It tells you where what's cheap and what's expensive, and how things are rotating against each other. It's another way to also tell you about market conditions. Market conditions is what causes the rotation of money to change differently. Just like water is priced in the middle of a city versus water being priced in the middle of the desert. And depending on how thirsty you are, it's the same thing. Assets get priced differently based off of the conditions that the assets are being traded under. The conditions that the humans are subjected to. Inflation, high inflation or increasing inflation is different than disinflation that is very low. People invest differently. Their money goes to more of the needs under an inflationary environment than the wants. So those things all change as interest rates change the value of net present value calculations and all that. He says, always be reading. Knowledge compounds. And you know how you become a better investor? It's not just by reading. I'm very good at looking at things visually and learning from someone else. I think getting a mentor is going to drastically increase the speed of your knowledge of investing. That's why all of you are here listening to this YouTube clip or video. That's why you're searching all throughout the internet to figure out, how do I become a better investor? What are the stocks that I should be buying? And that's the thing. You can find all the stocks, right? But you won't be able to hold on to them. You won't be able to control your emotions. You won't know the knowledge. You won't have the conviction of that trade. He says, wait patiently. Stay within your circle of competence. Think long term. Only invest if you'd be happy with the market shutting down for 10 years. The best way to reduce risk is to think. To clarify your thinking, write down your investment thesis. I have an investment thesis. I have a strategy. I'm showing everyone all of those things. I am reducing the risk by using those strategies. I'm thinking long term. I'm not doing short term investing. I am waiting patiently. Some of us, if you've been with the website for a while, there's some really good picks. We're up multiple hundreds of percents if you were able to wait patiently in those investments. If you're thinking long term, if you're looking at technical analysis, which I use as data points from an unbiased viewpoint, I'm looking at those data points and saying, what are the charts telling me? Is it validating the thesis and the strategies I have in place in my portfolio? I'm staying within what I know. So yes, he is completely right. And the fastest way that you guys can become better investors is by seeing how I'm doing it, or by seeing someone else do it who is pretty good at investing. Join our community if you'd like. You'll get better. I guarantee it. Biases that distort our decision making. So here's some biases. A confirmation bias. We interpret new information as confirmation of our existing beliefs. Availability bias. We tend to rely on information that comes to our mind easily, the quickest. Action bias. We favor action over inaction. That's why we sell or buy prematurely. Overconfidence. We overestimate our own knowledge and ability, often because we know too little to know better. Survivorship bias. This is a sample bias that occurs when we assess only successful outcomes and disregard failures. Much like some of the studies that they've done on millionaires and stuff. They've only taken the successful outcomes, maybe not the people who had the same strategies but were not successful. What biases do you struggle with the most? I've kind of tackled on all of these biases that I have, and that's why I created the strategy. What I did is I looked at the markets from the raw data. I looked at the charts. I overlaid a lot of things with the real estate cycle. I created a thesis and a strategy to eliminate my biases. I did not do very well as an investor when I first started investing, just like everyone else. Something's new, you need to learn the ins and outs. I used to listen to all the gurus, all of them. Peter Schiff, Mike Maloney. I used to listen to the peak oil guys. I listened to a whole bunch of information, soaked it all in, and I tried to become a better investor. And what really pushed me over the edge is when I started to just look at everything myself. I used some of their information to confirm what I saw in the markets and said, you know what, do interest rates do this? Does the real estate market align with some of these cycles? And the answer was yes, they do align. They are correlated. And that's what developed my thesis or strategy around investing during certain periods of time. So hopefully I eliminated a lot of those biases that I used to have perhaps, or following people blindly and their recommendations and not knowing the ins and outs of the market. Not becoming an expert myself, so to speak. Outstanding knowledge of technical analysis, indicators, and global macro fundamentals contribute very little toward trading profitability. Let's go to this next. The next one's a big one. Knowledge of self and the ways our emotions sabotage us at every turn. This is the beginning of profitable market speculation. Know thyself. What I had to do is I had to lengthen my time frame, become more patient, and I had to trade less to make more money. I had to really put faith in the ratios, really put faith in the technical analysis and the patterns, and to combine all of these things where they all came into alignment and had the tailwinds of those market conditions behind me to really make a lot of money. I think everything is still in alignment. The tailwinds are all still there. Now you have to master your emotions, guys. You have to master your emotions. You have to know when to pile on the money. You have to know your risk reward, your portfolio allocation strategies. All of that matters. That is the difference between a rookie and a seasoned investor. And having your emotions in check. Now here's some self-reflection here. It says, sometimes I forget how rich I am. My hot water works with the flick of a wrist. My AC works when I'm dripping. I can buy whatever groceries I want. I have a clean kitchen to eat in. I have a clean shower to rinse in. Sometimes I forget how blessed I am. Check your privilege. I know a lot of us want to become filthy rich, as do I. Why not, right? Well, we also have to keep in mind that we are already in the top 1% of basically all of humanity that's lived on Earth. We are richer than kings some years, decades, or I should say centuries ago. And we need to take that into consideration. We're already rich, and we need to check our privilege. So just, take a second, figure out just how rich we are already, and that we have it pretty well off already. Coming on down to my only uranium holding right now, Uranium Royalty Corp up 8% on the day. Love to see it. Big move here. I think it was down on 8-1. But all these are showing very good patterns here. This is the lead-in pattern that I always see. Get ready for the move, guys. It's coming. Probably very soon. Another one, it says a case can be made that a massive bull trend in silver miner ETFs is to begin. SIL could retest its all-time high in the months and year or two ahead. We have an inverted shoulder, head, shoulder. We could see a big move in SIL, SILJ. I think that these are very well positioned. The market conditions, I think, are coming around at some point for them to be successful in moving a lot higher. The market conditions that I'm referring to is the uninversion of the yield curve, the curve uninverting. That will happen at some point in our future. Someone asked me if they stack lots of physical metals, should they have an allocation to mining companies? If it were me, I would still have at least a small allocation. The reason is a lot of these mining companies are off the page cheap. When you do ratios, SILJ, GDX to gold, XAU to gold, doesn't really matter. And we're about to break to the upside here very soon. I think that's a really big opportunity that none of us have really seen in our lifetime, outside of maybe some very older speculators that got to experience the 1970s bull market. I think a 1970s bull market and the size of that could potentially come to precious metals at some point here in the future. And with gold and silver mining companies where they're at, I think they're pretty stinking cheap. So I'm going to have some allocation to it. And you guys can obviously choose whatever you'd like, but I'm going to have some allocation to it. But that's where I'm going to end it, guys. This is a pretty long clip already, so give me a thumb up for the content, subscribe to the channel, subscribe to the website if you'd like. Join our community, become a better investor. We are really digging down and looking at a lot of these companies in terms of across the board. I do look at the financials just real quickly. A lot of it is heavily based off technical analysis. That is what's worked for me in the past, more technical analysis than the fundamentals. But I still do check, look at cash flows, look at the operating cash flows. If they're continuing to increase, it's generally a good sign. The tough part is stocks generally move before the cash flows start to get, before you can see it in the balance sheets. So I always like trying to get in early towards a very good bottom. If the ratios are cheap and the market conditions are turning, if we're seeing that all these commodity charts are basically breaking to the upside, I'm going to go fishing. And I'm going to allocate those to where I think the infrastructure is in place to generate that cash flow that everybody wants to see. And if the market conditions are changing for that to occur, then I'm going to get in early. And the smart money is going to buy before those cash flows actually change. They're going to front run all that and try to get the best, earliest price that they can get. So that's what I try to do with the website. That's what I try to help people with, how to become better investors, what my strategies are. And there's a lot of discussion around all that stuff. Sometimes I go on some rants. I talk about how to become a better investor, why I'm doing it, where I'm doing it, why am I going into this sector, what are the ratios telling us, technical analysis on top of ratios, and why I'm going big in some of these companies versus other ones that I wouldn't go so big in. That is what separates better investors from rookie investors. It's allocating your portfolio to those that have the highest probability of success with the highest, we'll say, the best risk reward moves to the upside. So I'm really hitting those with a good chunk of money versus the potential outcome, but has a lot of risk. I know a lot of people, they want the big returns. They want to see their portfolio do a 40x. That's pretty aggressive. And you're going to have to take on a lot of risk to do that. I don't think the risk is worth that type of reward in some of these companies, but there might be some companies that give you that upside potential return and you don't have to have as much risk. There are companies in history, if you look back, that have done 100 baggers and maybe even some that are more than 100 baggers. And I don't think the risk was that bad in them. They weren't building a mine. They might have been an energy service company, or they might have been something that was a service company that was alongside something, or maybe it was a potential market condition where everyone got afraid, sold everything way off, and your entry point was there based off of fear in the market. That is how you can basically capitalize on these markets. And right now, there's a lot of chart patterns I see in commodities that have inverted head and shoulders, double bottoming patterns. They've broken the double bottoming and they're consolidating right at the top. These are considered ideal buy points from classical technical analysis. So The macro tailwinds are there. The ratios are telling us that they're cheap. And a lot of the cash flows in some of these companies are also signaling that they're very cheap on a price to cash flow basis. Seems like your alignment's there, guys. I'm taking advantage of it. I'm going to ride this thing through. I have been riding it through. I know I've gotten some slack from people telling me you should have sold off. You should have done this. You know what? Looking backwards, okay, yeah, everything looks great when you look backwards. But I still think the drivers are in place. If the drivers are in place, I'm not going to sell. I'm just going to accumulate on dips, ride this sucker higher. Accumulate, hold the rips in a bull market. We're still in a bull market, in my opinion. So that's what we've got. And guys, we'll catch you later. This is Finding Value.